Greetings and thank you for downloading the Superb Diamond Range podcast. This is episode 37 and it's going to be about mortgages as part of the financial series. So firstly, I'm going to start off with, what is a mortgage? Well, a mortgage is obviously something that most people these days, and maybe to a certain extent businesses as well, will take out a mortgage to fund the purchase of a home or maybe an office space or a building. So you'll find a lot of people will have a certain amount of money in deposit, maybe 10% or 20%. And of course, they'll then go to a bank to get a loan to basically, give them the difference that they need to make the purchase, basically. So it kind of like fills the gap on what they've got on deposit. Of course, there is times not so long ago where, there was 100% mortgages or 125% mortgages being given out with no money down, no deposit, nothing. But yeah, that was an interesting time, and maybe they will do that again, but it didn't work out too well. A lot of people were sort of given loans really easily, and some people, it's become a lot more stricter now, but back then they were giving them away willy-nilly kind of thing. So yeah, mortgage is basically a loan that you get to buy property with, and as I say, it just allows you to bridge the gap between you and your deposit. The way they work is they're a close-ended agreement, so you usually pick a time that you're going to repay over. Most commonly you'll get 25-year mortgages. Recently there's been a big push for 30-year mortgages, and I even heard quite recently about 40-year mortgages, which is kind of interesting. So basically the way they work is you will go to your bank, you may even go to a broker, and they will help you to find a mortgage to your needs, and that's part of the process that you'll go through. The way they work is you'll get a loan over, say, we'll use an example of 25 years, and you'll have to make a monthly payment each month. And as long as you keep to the conditions of your mortgage, as in pay them every month, when the term ends, you actually own the property outright. So there is sort of light at the end of the tunnel, if you can get there, but usually it is quite a long time that you'll be paying it, and a lot can happen. So there's certain things that you can put in place to protect yourself, be it insurances or emergency savings, or maybe getting a new job, second job if things go bad. So my personal experience with mortgages, I've gone through 2 mortgage applications in my life. I've had a property for about 5 years, and looking to get sort of a new property as well. To me, getting a mortgage is about preparing. So obviously, you need to work really hard to save the deposit. And this can take a very long time. The ideal situation would be to keep your expenses as low as possible. If you're renting a really expensive flat or apartment, it's going to take you a really long time to be able to save. So I would say, get your expenses as low as possible. There's plenty of people that may have moved back home with their parents, for example, if they're in that position, or stayed somewhere where it's a lot cheaper area, for example, and that's allowed them to save lots of money, quicker. But also, it can take a while, and I guess a lot of people will want to do things like go on holidays, and sometimes when you're trying to save a deposit, obviously if you can sacrifice holidays and eating out and, buying junk. Basically, you can achieve it a lot quicker. But one thing I should mention, it is getting so much harder, because especially if you live near a big city or just outside a big city, where you would find some of the prices are rising quite high, and even just to get a deposit now is getting really difficult and can take years of hard work and sweat. So but yeah, my experience with mortgages has always been that when you're going through the application process, to make sure that your bank statements are as clean as they can be, so you pay all your bills on time, you don't go overdrawn, you obviously make sure that they can see from your statements that you've paid all your bills on time, and that they can trust you to loan you such a large amount of money, and particularly over a long period. So they want to see a good track record of paying bills on time. In my experience, the first time I ever got a mortgage, I was actually advised by a work colleague at the time to use a broker that they used, and it was a very nice old man that I basically went round to his home, and he just basically made everything really simple. He told me exactly what I needed, and I think at the time it would have been 3 to 6 months bank statements, some pay slips from my work, so maybe 3 to 6 months of pay slips, and things like that, maybe references as well, that sort of thing. And they'll take that, and they'll also take into account your credit rating, which I may be doing on the next episode of the financial series, but I'm just researching that just now. But that would be quite a good one to talk about in the next one. But yeah, they'll look at your bank statements, they'll look at your income, they'll look at your pay slips to see that you've been in steady, stable employment. And obviously, if you're self-employed, they'll look at your all your evidence, and then they'll go on their computer and they'll basically put your details in, check your credit score, things like that, and then they'll just have the broker will have access to the whole market, so he'll be able to find you the best deal. A lot of people will usually ask their own bank that they've banked with all their life for a mortgage. And I'm not against doing this. I think you should always ask, because it's, I guess it's easy to just ring your own bank and they, know you really well and they've got your history. But I would also say, to get a broker as well, particularly a broker that doesn't charge you at least directly, but might make money on the deal. Because they're going to have access to the whole market, and there'll be other banks that may suit you more and give you a better rate and give you a better deal and better terms and conditions as well in your mortgage. So I'm pro broker. I think they do their job really well, and they can find you the best deal. And I mean, the second mortgage application I went through, the broker was really good. They actually came to my house or my flat that I was renting, and they basically, brought a scanner with them along with their laptop, portable scanner, and they, scanned all my pay slips, P60, bank statements. They needed some proof of pay rises and things like that. So they came and they talked me through everything, and then they sort of explained to me about the different types of mortgages that they offer, that are out there, and, what they all mean. And, having gone for a mortgage once before, I had a little bit of knowledge already, but if I had been a first time buyer, having the broker come round and break everything down and explain it, I found really helpful. So ultimately, your credit score will determine the interest rate you pay. So if it was a couple applying for a mortgage and one of them had squeaky clean credit, like a score of say 999 on Experian, and if the other partner had not so great credit, might have had some defaults or something, that would actually knock down the potential interest rate that they could have. So if they both had squeaky clean credit, they could get the best rates out there. But of course, if one person had bad credit and one had good, it would knock down the good person's credit. So then you'd kind of be at a lower, not so attractive interest rate. But the great thing about credit scores is that you can improve them over time. And as long as you get back to good behavior of paying your bills on time, and there's many ways you can boost your credit. Again, I'll talk about that in another episode. But you can, remortgage then in a few years' time. So you could maybe take out a fixed rate for 2 years, 3 years, give your credit time to heal and improve and be more attractive. And then obviously you just go in and remortgage. And again, you can use a broker for this, or you can go to the banks directly. Ultimately, if you've got a good credit, you're going to get a better rate and you're going to get a better deal and you're going to pay less in interest, which is, brilliant, if you can do that. There are different types of mortgages out there. So you've got fixed rate mortgages. So fixed rate, I'm a big fan of these. Basically, it means that you're paying the same amount every month. So you could do a fixed rate, which is, say, I'll just throw out a number of 500. So you'll only pay 500 a month. So every month, you got to pay 500 and that's it. So that's why I'm quite interested in fixed rate, because you kind of know where you stand. You know it's not going to go up or down. It's going to stay the same. So if you're into being stable and secure, fixed rate is always very good. And some people say that fixed rate can work out expensive. But what I like about fixed rate is there's not too much risk. You can almost be assured that you're going to be paying the same amount every month. And you can lock in a fixed rate for 2 years, 3 years, or 15 years, depending on how long you want to do it for. But I would always advise a fixed rate mortgage. There's another type that goes by variable rate. And a lot of the time when you come off fixed rate, you will enter into variable rate territory unless you remortgage or fix again. Variable rate is, I think for my US listeners, it's known as balloon mortgage or balloon rate. But effectively, a variable, like a balloon, it can go up and down. And this is all based on the Bank of England base rate. So what's going on in the overall economy in your country. And in America, I believe it's the Fed, the Federal Reserve. Not too sure, but I think it's kind of connected to what's going on in that department. Variable rates can go up and down. So again, you can go through a period where it's really good and you're paying very little every month for your mortgage, but then of course it can, at the flip of a switch, it can change and you can be paying like extremely quite high amounts. So you could go, say, from paying as little as, 300 quid to maybe paying as much as $1,000 or something. Maybe not even that much, but obviously on a variable rate, you might not be locked in to a variable, so you could always potentially make a phone call and try to change it to a fixed. But the problem, if you change it to a fixed at the time, it depends if the rates for fixed are good. So that's going to sound a little bit confusing, but it's all about timing and also your credit score as well. But if the rates are too good to be true, sometimes what I learned was I was on a variable for a short period, and I actually learned from speaking to the bank that the fixed rate I could get was cheaper than the variable rate. So that's why I decided to go back to fixed. And also, so of course there's many deals out there, and some people can ride the variable, period for a good while and pay very little. But again, I just don't like the idea of the risk involved and not being in control of what you're paying each month, being at the mercy of a hike or it's just, to me, just feels a bit inconsistent and not very secure. And that's, for me personally, I'm just not too keen on that. The other type is interest only. Now, this is still popular. There are plenty of people doing interest only. And again, the payments are much smaller than what you would have in a repayment mortgage, which is, part interest, part principal. So basically in interest only, you just pay the interest, so therefore your payments are usually quite small. The trouble with interest only is that when you get to the end of the term, I believe you're relying on your property to have gone up in value, or I think they say in America, appreciated. So if your property appreciates quite a lot, then it kind of covers, what you owe. Because remember, you've only just paid the interest, so you're kind of relying on the property to go up. And of course, you could get to the end of the mortgage and your property's actually lost value or gone down due to the timing and things like that. To be honest, I don't really have much experience with interest only. I've met people that have it. But to me, again, it doesn't really appeal. It doesn't seem like one that I would like to have. But again, each to his own. You might like the idea of the small payments. And I have heard a counter argument to interest only whereby A, you've got the small mortgage payments, but B, you could put the extra money that you're saving to the side so that you have a buffer. So when the time does come, you can pay it off. So I have heard of people doing that. But to me personally, if you're putting money in a savings, there's a chance that you might spend it or something could come up. So I like the idea of chipping away at the mortgage and, shortening it and making it, go away basically. I kind of feel there's a bit too much risk involved with interest only, but that's just a personal thing. But again, that's like how I feel about balloon rates and variable rates. Again, you get a fixed rate for a short period. So at the beginning of a mortgage, they might offer you an introductory deal, so it could be like, fixed rate for 2 years or fixed rate for 3 years. And the reason it's quite good is if you do decide that you want to move, if you're in a fixed rate, so if you're at the beginning of the fixed rate or the middle or the end, you'll pay a fee to come out of it. So it's good that you've got the fixed rate, but obviously you've got to ideally stay for that amount of time, because if you come out early, you can be penalised. So obviously you have to bear that in mind. So that's why sometimes being on variable, if you know you're about to sell or move, you probably might not get the charges or the penalties. So it can be advantageous to do that if you know that you're moving. But if you're planning on staying in the house longer term or even permanently, forever home, whatever you want to call it, then, fixed rate is the way to go. But if because I knew somebody that actually took out a 15-year fixed rate. And when they did this, they actually regretted it because they wanted to move to a bigger house, and they had already been 5 years paying the old house, which I believe was 1 bedroom, and they were trying to move to a 3 bedroom, and they actually had to pay massive penalties just to get out of a 15-year fixed rate, which sounded great if they were going to live there forever, but they kind of should have known if they were going to, buy one to move on, that they were going to get stung. But I guess some people don't really read the terms and conditions, or maybe the broker should have informed them if they use one, but I don't know, maybe they didn't use a broker. So there's different amount of years that you can do a mortgage over. I personally am a fan of, even though the payments are quite high, I would go for a 15-year one. Right now I'm doing a 25-year. The reason I'm kind of doing 25 is I realised that with overpayments I could chop it down to equivalent of 15-year, but in the future, if I ever did remortgage again and I think I could afford the monthly payments, I would consider 15-year, because under a 15-year one you'll pay much less in interest, and also 15 years is a lot quicker than some of the other terms, like for example, like you've got 25-year, and then you've got what's becoming more and more popular now is like a 30-year term. Now, I'm not a fan of 30-year. I prefer 25 or 15, but a lot of people are being sold 30 years because they're being told things like, oh, well, you're young and the payments are smaller. I asked for a comparison between a 30-year and a 25, and just in monthly payment terms, they were saying, oh, well, you can save £50 to £70 a month. Just by, doing it over 30 as opposed to 25. And I still insisted on doing 25 because I thought, well, A, it sounds better, and B, it's going to be paid off quicker, probably pay less interest. And what people don't realise is, the payments may be smaller over 30 years, but it's still 5 years extra payments, and you still, over the whole 30 years, you're going to be paying way more in interest than a 25 or a 15 year. Recently at my workplace, I had a colleague that was talking to me about a friend of his that recently bought a place, and he opened up a mortgage calculator to kind of show me how much the friend had bought his flat for, which was like a city centre flat. And he was kind of boasting that he was paying $250 a month, and it was much better than the rent that they were paying. And I just asked him, what was the term for his mortgage, and he actually shocked me when he said a 40-year. So he'd actually gone out and taken a 40-year term. And okay, at the time, obviously the payments seemed pretty small, $250, and you think, wow, that's pretty decent. But to me, it's like, that's a small payment, but look how long he's going to be paying that mortgage, and so much can happen between now and that 40 years. So to me, it was shocking that they do that. But I guess people now have been sold on payments. It's more and more popular for people to spread things over payments over time. Particularly people now, they might be buying furniture, which is part of when you move, you might be attracted by buy now, pay later. But you can always get sort of tripped up when you get to that pay later stage and you don't actually have the cash to pay it, and you can be, interest can be backdated. So to me, it will seem cheaper, but really and truly, 40 years, ridiculous. Like, to have a mortgage for 40 years. I'm not even too happy with 30, but it's still better than 40. And like I say, 25 or 15 is ideal. But yeah, to me, you can always remortgage, so you can actually get that term down. So if you're in a 30-year just now, or a 40-year for that matter, maybe look into reducing down next time you decide to remortgage, so that you can, have a shorter loan. Because to me, it's quite a long time, and there's going to be a lot of interest made from that. But there is ways to negate interest and cut down the term, but we'll get into that later on. Home ownership versus renting. So home ownership, in my opinion, a good way to build wealth is through home ownership. Renting is okay. I like the idea that you can live anywhere pretty much, and you have a bit more freedom in that, if you get a job in another city or another country, you can just drop things and go. So I do like the freedom side of renting, whereas if you own a home, you have to wait to sell it, you have to hope to sell it. You get a bit held back, like an anchor almost, but at the same time, sometimes you can get a lot of money from owning a home. Again, if it, as you guys in America say, if it appreciates and goes up in value, then obviously you'll get a check at the end, and it'll be pretty decent. And sometimes just getting a starter home can lead to getting a much better property in a better part of town or in the country, wherever you want to live. So yeah, ultimately home ownership I think is better, but I can understand the argument for renting, because it is freedom, and you really do have the ability to just be like, pack your bags and just get the hell out of there, when you want. Whereas home ownership is different. This is a kind of topic that could go a lot deeper, but I just want to stay focused on the mortgage for the moment. But who knows, in future episodes we could talk about the home ownership versus renting scenario. Okay, so I'm a big fan of overpayments, and the reason I like overpayments on mortgage is you can reduce the term, you can reduce the amount of interest you pay. It brings you closer to your goals of being mortgage free, maybe to some extent being debt free if you've got no other debts but your mortgage. So to me, I think overpayments, even though when you make an overpayment, it is locked away in that you can't really get it back. So I would always recommend having an emergency fund in place before even considering overpayments. But to me, overpayments are so important because every overpayment you make, the closer you are to one day paying off your mortgage and owning the property outright. And as I say, when you walk on the grass and you own it, it's a completely different mindset and feeling, like nothing else. And I mean, as I said, if you pay off your mortgage, that's you. That's your main expense is gone, and then you could maybe start doing things you enjoy. So obviously, there's things like bi-weekly payments. So in America, there's quite popular that you can speak to the mortgage lender, the bank, and make bi-weekly payments, which, if I'm not mistaken, you make a payment twice a month or every 2 weeks, and that actually means you make an extra payment a year, and it's equivalent to, I think it's an extra month a year. So over 12 months, it's like making a 13th month payment. And again, you can do this by just overpaying with your monthly amount anyway, but that's one strategy of doing it without actually feeling it. And of course, over a 25-year mortgage, this extra month could trim down your mortgage by 25 months, which is kind of like almost 2 years or so, maybe more, the way that it compounds and different things. But yeah, I mean, monthly overpayment strategies are great, and there are many of them. I mean, there's a one called the HELOC strategy, which, is one method, and then there's, just making overpayments in general, which is, going to equal, again, less interest and less time to pay it. You can get rid of it quickly, and, as I say, your whole world changes. And most important thing, I think, moving into a new property is having an emergency saving, and that allows you to avoid being foreclosed on, because your main priority is paying your mortgage. That's one of your main bills that you need to pay if you want to have a roof over your head for yourself and your family. So obviously working on emergency savings is essential. You do not want to be foreclosed on. You do not want to lose the property. It's just, so that is your main thing that you need to do. So obviously, the sooner you pay off the mortgage, the better. I would say the main message behind it is that it equals a lot of freedom. Imagine your biggest monthly expense is no more. So I would just say, the main thing is choose the best mortgage with the best rate, ideally a fixed rate, but again, that is completely up to the individual. But for less risk, getting a fixed rate, getting a short-ish term, 15 year, 25 years, pretty decent, and aiming to pay it off as fast as possible, making sure they have emergency savings in place. And, the sooner that you pay off the mortgage, it's going to be life-changing. You're going to have the ability to maybe not have to work full-time. Maybe you want to reduce your hours, go down to part-time. Maybe you want to do something else that you've always wanted to do. Maybe start a side business. Again, not having that massive mortgage payment every month, you're going to have much more freedom, and you're not going to need as much money, and you might even be able to do things that you've never done before. Like you might be able to go and travel. I knew of one guy that had a house and he decided to rent it out, and he ended up going to Thailand to live. So basically his mortgage was paid off, somebody was renting his home, every payment he was getting was going straight to him. And of course, living in Thailand or the likes of Philippines, that you don't really need very much money to live quite a good life. So, the guy was laughing all the way to the bank, as we say over here in these parts. So yeah, definitely, getting a mortgage, is the one type of debt that I think is necessary. It's not so easy now to just go out and buy a home for cash. It's really difficult, particularly if you live in an area where house prices are really expensive or rising, or in a city. So ultimately, getting a mortgage is an okay debt. It's not, trying to get a good deal on it is important though. You don't want to get a bad rate and be, in a lot of trouble and be unable to pay. It's got to be realistic. you've got to be able to comfortably pay it as well. And there are other expenses to take on board of being a homeowner, because a lot of things can go wrong. So I would add to this that you do need to think about your insurances. Yeah, insurances will be another episode, obviously, but definitely get, home and contents insurance. And if you've got a boiler, maybe get some boiler insurance, because you don't, things like that, when they break down, can be very expensive. And the last thing you want is to be, short of money and unable to pay your priority bills. So that's all I'm pretty much going to say on mortgages. But, I hope you've enjoyed listening to Superb Diamond Range financial series. And like I say, I think next time we'll be talking about credit ratings and credit scores, because I think that is very important, especially in today's financial world. So once again, thank you for listening. And again, if you've enjoyed listening to this podcast, please recommend it to your friends and family. And also, if you get a chance and you're on iTunes, if you could leave me a review to help me sort of rise up in the rankings. And once again, be wise, be smart.